Listen up, because while everyone else is still paralyzed by 7% mortgages, a quiet revolution is happening. A silent group of savvy investors? They're locking up properties at 2020 prices, right before the biggest supply cliff of the decade slams into us. If you miss the next 12 months, you won't just miss an opportunity. You'll wait another 10 years for a setup this good to come around again. Seriously, this is it. You're probably hearing the headlines scream crash, right? But the numbers? They're whispering, last call. Here's the thing. Existing home sales are actually forecast to jump by 6% in 2025 and 11% in 2026. Yet, JP Morgan, for example, projects home price growth under 3% for 2025. That spread, more buyers, but smaller, more modest price gains. It's a rare bird. It only happens once per cycle, right before inventory finally breaks loose, and all those late entrants come rushing in. The last time we saw this kind of math was back in 2012. If you were smart enough to buy then, you probably doubled your equity by 2022. If you waited, well, you're likely still renting, aren't you? Don't make that mistake again. So, where's the action? Where are these silent investors placing their bets? Let me tell you, it's not always where you'd expect. Tampa-Orlando, I-4 corridor. Florida's population, it just zoomed past 23 million in 2025 and is still adding 1,000 new folks every single day. That's incredible growth. Median single-family lots here still trade for under $270,000, which is wild. But here's the catch. The big insurers just hiked rates by 40%. Locals are panicking, but smart investors, they're swooping in on cash flow duplexes. One side alone can often cover that premium, making it a no-brainer. Carolinas' tech belt, Charlotte to Raleigh. This region has been absolutely buzzing. From Charlotte to Raleigh, this tech corridor has added 250,000 remote work jobs since 2020. New listings barely sit for 2 weeks before they're snapped up. Build-for-rent communities are pre-selling entire phases to institutions at 5% cap rates, leaving individual buyers the leftover lots that are quietly appreciating 6 to 8% a year. It's like finding hidden treasure in plain sight. Midwest infill. Kansas City, Columbus, Indianapolis. Boring? Absolutely. And that's exactly the point. The entry price is around $180,000, and the rent covers a 6% fixed note. No problem. Plus, the foreclosure risk is half the national average because lending here stayed, well, boring too. These metros behave like bonds with a fantastic upside every time an employer announces 500 new jobs. It's steady, reliable, and seriously underrated. Now, let's talk about money. Forget the outdated idea of needing 20% down. That's old news. Savvy community banks inside these growth corridors? They'll happily portfolio a loan at 85% LTV, but you've got to show them 12 months of verified rent on a similar property. What does that mean for you? Translation: $50,000 in the bank can buy you a $300,000 quad that cash flows from day one. Your rates might reset in 5 years, sure, but by then, you've already forced appreciation through some minor cosmetic splits. Maybe add a kitchenette, lease the basement, you get the idea. Then, you refinance on that new, higher appraised value, pulling your original capital out to repeat the process. I coached an investor last year who used this exact playbook on 3 houses in Fort Myers. He's already recycled the same $65,000 twice, and now he controls $1.2 million in real estate with less personal debt than most people carry on a car loan. It's a game changer. Nationally, we're facing a massive housing deficit, estimated between 3.2 to 4.5 million units. Builders finally broke ground on new subdivisions, which is great, but those deliveries? They're peaking in summer 2025 and will likely stall hard in 2026 when federal subsidy cuts really hit. If you manage to close on a property before this wave, you'll ride that equity pop and rising rents like a pro. But if you hesitate, if you wait, you'll be competing with institutional buyers who are armed with a 3% cost of capital once rates normalize. That window is narrowing, folks, to roughly the next 4 quarters. After that, cap rates will compress, and positive cash flow. That's going to become a nostalgia trip. The opportunity is now. All right, so what do you do right now? Step 1. Pick one growth corridor. Don't overthink it. Drive the streets, really get a feel for the area, and identify that missing middle inventory. Think a small quad or a 1950s ranch on an oversized lot. Target properties under $180 per square foot, especially where new construction costs are hitting $220 per square foot. That's instant equity. Step 2. Line up your community bank pre-approval before you even submit an offer. These lenders keep portfolios on their own books, which means they move fast when you arrive with solid rent comparables. Be prepared. Be decisive. Step 3. Buy on actual, today's rents, not some rosy pro forma. This is crucial. Force the value with quick cosmetic splits. Think a fresh coat of paint, minor upgrades, then refinance, pull out that equity, and snowball it into your next deal. Aim to own 3 doors per million in net worth you want by 2030. That math still works, even if price growth stays stuck at a modest 3%. Look, the headlines are screaming about a crash, but the numbers are whispering that this is your last call. A 4% mortgage might never come back, and honestly, who cares? A 6% fixed community bank loan combined with a 6% cap rate in a job growth metro? That absolutely beats waiting around for some miracle. Inventory is tight, rates are stable, and demographics, they refuse to slow down. Stack 3 properties in the right corridor before this supply cliff hits, and you'll fund the next decade of your life. Wait, and you'll just fund someone else's. The market is changing forever. The only real question left is whose name ends up on the deeds.